So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, how many shares of stock should you buy? So I'll give you my honest opinion on this, and I think the answer is 0. I do not think that you should generally use stock unless you're forced to use stock in your account. Now, this is my opinion on this, and I think that stock is incredibly inefficient and also requires a lot of capital. So what do I think you should do instead? Is I think you should use options to trade stocks synthetically. And so what I mean by this is that if you are absolutely, bent on owning underlying shares of a particular company, why not just trade the synthetic equivalent of long stock, which would be to buy an at-the-money call and sell an at-the-money put. And by doing that, you basically trade the synthetic equivalent of what would be a long stock position, but the requirement for capital would be considerably less to do this. Now, if you're in an IRA or retirement account, you can also replicate very similar a stock position by buying a deep in-the-money call option with maybe an 80 or 90 delta. And that would, again, require much less capital and be a little bit more efficient in not only replicating the upside potential of a stock, but also protecting you in case the stock actually moves lower. So I think unless you are forced to do it, or unless you have some underlying assumption that requires you to own stock, actually owning shares of stock is incredibly inefficient and also leaves you open and vulnerable to a lot of risk. Now, if you do decide to buy stock, the number of shares would be equivalent to the amount of risk that you're allowed to take for that position. Since we openly suggest that people should never invest more than 1 to 5% of their account in risk per ticker symbol, I would suggest that you keep the allocation really low. So if you buy shares of a particular stock like Amazon or Google or Netflix or Tesla, which are all higher priced stocks, you would want to keep your share count low so that the capital that you have at risk and in the market exposed is less than 5% of your total account balance. As always, hopefully this helps out. If you have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.